If you want to know if Santa Claus is coming to town or not for the stock market this year, the next 4 days are going to determine just that. We're about to get into the earnings that are coming this week, kind of my expectations here, what it means for if Santa Claus is coming to town. I'm sure you guys have heard a lot about a Santa Claus rally. So we'll speak about that in this video here today. And then I want to react to a couple videos, okay? First one up here that I thought was really important is the FICO CEO, which I'm sure you all know about the FICO credit score. This is one of the most in-tune people in regards to understanding what's going on with the consumer, where the consumer's at. We just got a horrible, and I mean absolutely horrible consumer sentiment number. So I thought it'd be really important to listen to this FICO CEO and hear kind of what his stance is and what he says. And then we're going to listen to Mr. Adam Peter Parker and his views on not buying small caps. He says, do not buy small caps yet. It is too early to start buying small caps. So I want to hear what Mr. Adam Peter Parker has to say in regards to that one. Appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed. New all-time high subscribers in the history of the channel. I appreciate each and every one of you, which, by the way, I just got back from St. George, and then I was also up in Zion National Park. Not sure if you guys have ever been to Zion National Park before, but it's absolutely gorgeous. We call that God's country out there. Absolutely beautiful. Okay. Alrighty, guys. So first up here, this is what we call retail week. This is arguably the most important week for the actual stock market. And the reason being is big tech, we know those companies are always going to come through, right? Microsoft, Meta, Amazon, those companies are almost always going to come through. They're almost always going to report really good numbers, right? But underneath that top magnificent 7 layer, or whatever you want to call it, you have the rest of the market, right? And the rest of the market is really, a lot of it's supported by the consumer, right? And so when we have retail week, this really lets us know how the state of the consumer is actually doing. We can see consumer sentiment surveys, we can see this and we can see that. But at the end of the day, what's actually going on with these businesses, their company fundamentals, their earnings, this is what matters, right? In this week, we got some huge guys. We got the Home Depot reporting earnings, right? That's massive, massive. We have Target reporting earnings this week. That's massive. You have Cisco and a few other tech companies that haven't reported. You got TJX, which is reporting, right? And a lot of these are smaller market caps, but do not mistake smaller market cap for not mattering to the stock market. Because I'm telling you, these matter significantly for the understanding of recession, no recession, Fed have to raise more, Fed going to stop raising. Walmart, Ross is going to be reporting this week, and a few other retailers as well, okay? Now, which one of these matters the most? I'll tell you exactly which one matters the most, okay? This one right here. Target matters the most out of everybody. Is Target the biggest market cap? No. Home Depot's market cap is usually substantially larger than Target. Walmart dwarfs Target in terms of market cap, but Target is the most important. And the reason that one's the most important is there's obviously a tremendous amount of concerns about recession for 2024, okay? A company like Target is seen as a little more, we can call it discretionary, than, somebody like a Walmart that is very grocery based, that's very needs based, that Walmart's really been benefiting huge from all the inflation that's been going on because the consumer's been tight for the past year to year and a half. And so Walmart's really benefited while Target has been hit very negatively because of essentially the consumer's in a tighter spot. Like at the end of the day, just be honest, and I'm a Target shareholder. If Target, if you're comparing a price at Target versus a price at Walmart, Walmart's almost always going to beat them. Almost always, if it's the same exact product. And so Walmart thrives in that sort of environment. So Walmart's going to put up their numbers regardless, okay? Target's the important one because that's really going to let you know if they see any sort of much more material weakness in their business, recession. If they give a really weak guidance number, recession, okay? Now, on the flip side, we actually can't see too hot of numbers from companies like Home Depot, Target, or any of these other retailers because if we see too good of numbers, which I know this sounds silly, but it's the truth. If we see too good of numbers, what's essentially going to happen is people are going to start getting fearful of, the Fed's going to have to keep raising in 2024, higher for longer, and everybody, that's going to freak the market out, and we're not going to get Santa Claus to come to town, okay? The best situation actually for us is that we get decent numbers and decent guidance. The numbers don't have to be great, and they don't have to be horrible. If we can avoid great and horrible, then we're talking. I think there's a very low probability we have great numbers coming out of any of these retailers. I don't think Home Depot's numbers are going to be great. I don't think Target's numbers are going to be great. I don't think TJX numbers are going to be great. I don't think Ross Stores numbers are going to be great, or Gap numbers are going to be great, or any of these retailers, Macy's. I don't think any of these guys are going to report great numbers. So that's not really the risk. I think we're either going to come in like, okay or bad. I think that's one of the two scenarios. We're either going to come in okay or come in bad. And we got to avoid bad, though, because I can tell you, if we get bad numbers from all these, then everybody's going to start running with, did you see Home Depot's numbers? Did you see Target's numbers? The consumer's done, recession 2024. And then you get another leg lower for the market, right? Because then everybody gets convinced that, recession's coming, valuations have to go lower, everybody's earnings going to go lower, job losses are coming, then everybody be convinced of that, and then Santa Claus won't be coming down in that sort of situation, okay? So this week is absolutely massive for the market. I mean, massive. And that's the situation in regards to that. Okay. Already 2 videos for me to react to now. First one up here is this one from the FICO CEO, which is very important. This should got way more than 14,000 views. I mean, it's a gentleman you want to hear, listen, you want to listen to here. And then we're going to listen to Adam Peter Parker, why it's not time to buy small caps.
Sentiment slipped for the 4th straight month in November. The University of Michigan survey showed a reading of 60.4. That's lower than
so real quick here in regards to this number, horrible number. But, keep this in mind. We've been at horrible numbers for over a year and a half. And yet company earnings have been decent, right? The consumer's still been out there spending. The restaurant numbers have still been phenomenal. And we've had a year and a half of horrible consumer sentiment numbers. I mean, among the lowest you've ever seen since Michigan consumer sentiment goes all the way back to the 1950s. And for the last year and a half, we've been at among the lowest numbers we've ever been at in history of that survey. We actually hit the lowest number ever in history in 2022. And so it's important to understand that just because consumer sentiment is so bad, it doesn't mean people aren't out there spending. Look at restaurant earnings the last year and a half. Look at a lot of these guys' earnings a year and a half. Like, they've been pretty darn good, right? Like, Apple's still been putting up their damn numbers. I don't know how they do it. They haven't been very impressive, but they're still meeting numbers. It's pretty incredible, actually.
Let's bring in Will Lansing. He's CEO of FICO. The company reported 4th quarter earnings earlier this week. Will, it's great to have you on the show. Thanks for being here.
Oh, it's great to be here.
Your stock finished the day up 3.5% at a fresh 52-week high today. A lot to get to, including what you're seeing with the consumer. But the fact that your business is broken down into 2, it's really scores and software revenue. And the fact that you're continuing to grow as strongly as you are got my attention, given the fact that we do have higher interest rates.
FICO is a crazy story because this is basically a business that has like a monopoly on the credit score industry. It's absolutely insane.
We have some signs that credit is tightening here, and yet you're powering along. Why?
Well, both businesses are in great shape. Consumer credit is the foundation of a consumer economy. And our business has really benefited from that. I mean, we're a 68-year-old company, but over the course of that time, our scores become so deeply embedded in the credit evaluation process for lenders that we're really we're what makes the economy go. And so the scores business is very strong. And then we have a newer business, which is our software business, and that's also booming. That's all about helping B2C companies optimize their interactions with their consumer customers. Both businesses are just on fire.
Yeah, and of course, both businesses, to your point, tie back to the consumer. So, what are we seeing cracks in the consumer yet, or is it resilient?
Good question.
The consumer is pretty resilient. I mean, I guess I would start by saying FICO scores are a lagging indicator. So there are other indicators that would give you a little more of a forward look. What we see is stability around the FICO score. It's around 718 right now, which is up a couple of points over the last few months. But that's a stable score, and consumers doing okay. There's a little more debt out there. But we see a pretty stable consumer. What's killing us is interest rates, of course. I mean, that's really decimated the refi market, the mortgage refi market. And it's also a challenge just on new mortgages.
I mean, we've seen that credit scores
two things here, okay? One is I was thinking about opening up a hedge position against FICO in 2024. I want to speak about that in just a moment. But in regards to the consumer, like what I think he's just kind of I don't think he sounds very bullish. I don't think he sounds very bearish. I think he sounds kind of like, things are okay, with the consumer and whatnot. So I just think that was kind of telling his kind of like views on that, right? Now, am I still thinking about betting against FICO in 2024, given that we know there's going to be likely still the loan environment is going to be horrible likely in 2024 as well? And the answer to that is no. And the reason being is one, I'm convinced that still like loan demand is not going to be good in 2024, whether it's auto loans, home loans, refis, anything like that. But with that being said, this company, it hasn't been good for like a year, and yet this company's still putting up these amazing numbers. And so I'm like, damn, man, like, how can you bet against a company, even as a hedge position, if they put up these sorts of numbers in this sort of environment? Like, look at the growth rates they just reported. It's freaking phenomenal. And so I'm looking at that and I'm like, damn, I'm not going to be able to do it. I'm not going to be able to hedge against that one. And yeah, the valuation's high, but if you're hedging against a stock just because the valuation high, it's usually not a good decision. There's got to be something fundamental that's breaking in that business model, that's really going wrong, that's deteriorating. And I'm like, damn, man, like the loan environment's not good and this company's still growing the way they're growing. Like, what happens when the loan environment's better, whether it's 2025 or 2026 or whatever year that is? I'm like, what are the numbers they're going to put up in that environment? So I'm guessing they're going up on their customers. And at the end of the day, they kind of have a monopoly in the industry. So what are they going to do? Like, literally, what are you going to do? You run an auto dealership, and FICO goes up on you, and it's more expensive to run credit scores. Or you're a lender of any kind. What are you going to do? Still get your FICO credit score? There's not like you're going to do something else. You're going to stick with them. Like, they would have to go up so much money. It'd be ridiculous to make them say, I'm going to go for an alternative option. It's not like if McDonald's went up, you say, okay, I'll go to Burger King instead, or I'll go to In-N-Out or whatever. This is a whole different ballgame. And so when you have like a monopoly in the industry, it's a pretty dang good thing for them.
All-time highs. What's been fascinating to me is the fact that during the pandemic, folks were able to pay down some of their debt. They were able to boost their savings. You had stimulus checks coming in, not able to spend as much at the time, maybe strengthen their credit standing, and thus be able to take on larger lines of credit. And now they're starting to spend in this higher inflation environment. It's almost acted, I think, as a second wave of stimulus. Am I right to think about it that way?
Well, I think there's some truth to that. Absolutely. The nice thing is that consumers are increasingly sensitized to how important it is to maintain a good FICO score. And so responsible behavior is now paramount. I mean, consumers really think about the impact of their payment behavior on their credit score and what it means for the price of credit and the availability of credit in the future. So I think they're just a lot more sensitized now than they have been in the past.
So what is higher for longer from the Fed? Because we know that's been the message. What does that mean to this entire picture looking to 2024 and for your business?
Yeah, and by the way, it's very important we keep good credit scores in the United States. And the reason being, folks, is if you're talking about any rapid deterioration in the credit score, what that means for the economy is absolutely positively devastating. And the reason being is, we saw this in the great financial crisis, right? A lot of short sales, a lot of foreclosures on homes. People burned a lot of creditors and credit cards and things like that, right? Everything was in a bad spot, right? And so that doesn't just devastate in the short term. That devastates over the next several years, because then those same people that had to have that foreclosure or had that car repoed or burned the credit card companies or whatever, their credit was bad for years to go in the future. And so this is one of the reasons we saw debt levels fall across the board when it came to the consumer after the great financial crisis and coming out of those next several years. I mean, that's almost something you never see. You almost never see the consumer debt going down. But we actually saw that phenomenon. And the reason was people just couldn't get the credit. Even when let's say they lost their job, they had to burn credit card companies, they got their house foreclosed or whatever, right? And let's say they finally got a job in 2010, 2011, right? Their credit score is still crap. So it's not like they could get credit cards at that time. It's not like they could go get the auto loan, the home loan, those sorts of things, because their credit score was awful. And so no one would lend to them. And that wasn't just a small amount of people. There was millions and millions of Americans during that time, right? And so this is why I think an interview like this is super important. And it's very important everybody understands how big the FICO credit score is, not just to you as an individual, but to the overall economy and how all that works in regards to credit.
When we look at the score side of the business, we see, mortgage volumes are about as low as they've been in decades. And we don't see it coming back very fast. We do see it coming back. I mean, sooner or later, people will be buying houses again. And if we have a 1 or 2 point decrease in mortgage rates, which could be a while in coming, but if we have that, we're going to see the refi market come back too. That could be towards the end of the year. That could be next year. I mean, it could be some time before that comes back. Yeah,
I'm pretty much in agreement with him. It could be at the end of 2024. It could be, beginning of 2025, something like that. We know mortgage rates. We know mortgage rates are going to be high here for a bit. It's just the bottom line is like We're not getting out of 7 to 8% type mortgages in the short term, right? That's going to be with us. So 12 months from now, that could be a very different story. 18 months from now, it could be a very different story. But for right now, we know we're kind of stuck with these 7s or 8s, somewhere in there. Alrighty, time to listen to Adam Peter Parker on why it is not time to buy small caps.
With the rally, take a look, the scorecard.
By the way, just so you guys know, massive Black Friday sale coming up. That will be pinned comment down there if you want access to that. $62. $62. I want to make sure we did something that everybody could afford this year. You get access to my Become a Master Stock Market course, which is usually a $997 course. That's my #1 stock market course ever. You also get the ability to see what stocks I'm buying and selling each week in that Fidelity account in the Patreon. And then you also get access to see exactly how I diversify a portfolio out through GVD. So yeah, everybody can afford that one. So I wanted to do that for Black Friday. So if you want access to that, it's going to be a one-day sale. Then check out pinned comment down there, enter in your info, and we'll send that over on Black Friday. $62, baby.
To go in regulation, that 4,400 level on the S&P, we are above that. It hasn't closed above there since back in September. So,
by the way, I didn't even see how my account was on Friday in terms of what it closed at and whatnot. I got to see where the portfolio ended at here on Friday. Let's see, public count. Where you at, baby? Where you at? Ooh, it was a good day on Friday. $30,765.98 up in the public count on Friday. It was a good day. Okay. Man, maybe I should go out of town every weekend. Every Friday I should leave out of town. Holy smokers, that's no jokers.
Watch that over this final stretch. Elsewhere, strong across the board. A big reason we're here today, mega cap tech. Several of the big names with really nice gains today. Apple around $185 above that level. Look at Microsoft.
The best part is I made all that, the count was up $30,000+ on Friday, and then I went to Zion National Park, where Zion National Park, you don't even really spend much money, you pay for the parks and whatnot, but it's mostly outdoors. It's not like going to, a big city or something like that where you're fine dining at all these fancy restaurants and stuff like that. So damn, man, okay.
Time high today, and NVIDIA back above $480. That's near 7% over the past week. And that's where the move has been the strongest.
It's going to be funny when people are playing
NASDAQ,
600
not
for it.
surprisingly, the outperformer as it has been for the entire year. If there's a knock this week, it's the Russell 2000. It's been mired in a long and painful slump, even though higher today, as I just showed you. Small caps can't get much going lately. And not the only sector of stocks, that's for sure.
Can't get much going lately. They can't get something going for over 3 years. Let's be quite clear about this. The Russell hasn't been able to get anything going for over 3 years. The Russell's lower today than it was 3 years ago. So I just want to be quite clear about the state of the Russell and how long it's really been bad. This is nothing new. This is over 3 years now.
Which leads us to our talk of the tape.
It won't stay like that forever, but it is like that right now. Damn.
Does it make a difference to the rally if it continues to be led by the biggest names in the market? Let's ask Adam Parker. He is the founder and CEO of Trivariate Research and a CNBC contributor. Look, that's the knock on the rally all year. Does it matter or not?
Not really. Not really. I mean, if you're trying to beat the S&P 500, then you have to own a chunk of those names. We've been saying that for a couple of years. And if your job is to, beat the S&P, you got to risk manage those names and get your alpha elsewhere, right? So, as we've been saying, it's very unlikely, I think, in the next 3 to 6 months that the small cap companies are going to have more achievable estimates or have more margin expansion than the big 7. It's just unlikely. Why? Well, you need wages.
So this makes me think. Let me see how my small cap stocks did on Friday versus, let's call it, my big cap stocks on Friday. This shall be very interesting. Let's see. So public count. So Meta had a great day. Meta was up almost $15,000. Tesla was up $7,700. Amazon $3,000. Palantir Palantir was up $7,777. Dude, that's sick. I'm screenshotting that. That's freaking sick. Elf, on the other hand, was down. I was down $4,300 on Elf on Friday. And then Fubo was down 3%, so down $1,200 there. So the Planet was up substantially. Planet was up 14%. Cheesecake was barely up, though. Cheesecake was only up 0.3%. Revolve was only up 0.3%. So it was pretty much the story. Why the hell was Palantir up so much? What a day for Palantir. Holy smokes. I'm going to have to look into that. Like I said, I've been kind of out of the market. I was, up there as Zion with the family. So Holy smokes, that's no jokers.
To be more beneficial, commodities, depreciation, pricing, and mix. The small cap companies just don't have as much of that as the big ones. So I think it's going to be hard to have a big market rally and not have the Magnificent Seven like pro rata participate.
Well, of course, but it's a matter of the other stocks that are not participating. And, look, when the S&P was at 4,000, people hated it because they're like, well, it's only being led by the 7 stocks.
Right.
And then when it was at 4,200, hated it still because, well, it's a Magnificent Seven and nothing else. Well,
that's true.
Here we are at 4,400, and in large part, it's the mega cap stocks and kind of everything else. I mentioned what the Russell's doing lately, and it's ugly. And a lot of these other sectors, energy's done nothing, healthcare's done nothing.
It depends on who you gathered the money from, your investors, and what fees you charge and what your mandate is. But if your mandate is long only beat the S&P 500, you absolutely have to own at least a market weight of the big 7. You don't know anything about them. The idea that somebody knows something about Google that isn't in the price, I think, is rough. Or Microsoft or Apple. They're covered by 4,000 buy-side analysts and 60 sell-side analysts.
At what point do these stocks?
So another point, I don't think enough people talk about this, right? In regards to the biggest stocks doing great in the market, right? I think one of the points they miss, which is like so glaring and so huge, in my opinion, that doesn't get talked about, and I think everybody should be aware of this, is think about it, right? Everybody for the last 10 to 20 years has really been kind of, funneled into index funds. Like if you invest in the stock market, most people, if they invest in the stock market, they do it through some sort of index fund type instrument. A lot of people don't want to do the research I do and, look at balance sheets and income statements and PE ratios and then try to judge business models and build out their own portfolio of 10, 20, 30 stocks, right? They're like, I'd rather just, I don't want to put in the work. I don't know what I'm doing. I'll just buy an S&P 500 index fund, which is fine. That's their thing, right? But in doing that, just understand there's going to be constant buying pressure consistently in many of those biggest stocks, right? Because the weighting, how those stocks are weighted, essentially, the most money is going to go to the biggest, right? And so the most money is always going to go to companies like the Apples and the Microsofts and those sorts of stocks. And so it's an interesting phenomenon now where it's kind of like the rich get richer a little bit in regards to the biggest mega cap stocks. And you're always going to have some sort of selling pressure on those because people are retiring. They might sell some stocks, things like that. But ultimately, you always have just a huge amount of money going in those stocks. And it's basically a week in, week out dealio, right? Because people get paid every week or every 2 weeks or whatever. And so a certain portion of their check goes toward all those stocks, right? And the majority of the money is going to end up going to the biggest of the bigs. And so that's just something that goes on nowadays. Yeah, so as long as people are always funneling money in to stocks through their index funds, through their workplace and their 401ks and all that, I mean, those stocks are going to perform better, even if their business models. And you wonder why Apple's doing really well, even though their business model is not doing well and their business model is actually in decline. Apple's the biggest weight. So every week or every 2 weeks, actually it's literally every week, right? Because, everybody gets paid at different pay schedules and whatnot. Every single week, massive amounts of people's 401ks, index fund money, whatever, is getting put into Apple stock week in and week out without fail every single week, right? Huge.
Cost themselves,
when their earnings,
and then everything else
when their earnings are less achievable and their margin expansion and growth is less attractive. You know what the answer is? When things get much worse and 6 months before the accommodation's coming, then you buy small caps because they're going to recover more lower quality small cap stuff work. So if we still think they're going to raise one more time, or we're still at that part of the cycle, why am I going to go all the way anticipatory to 3 to 6 months before? So things have to get way worse before that works.
So
you're
saying it's too early.
Way too early. Yeah.
For small caps.
That's right.
Because they haven't troughed yet.
Yeah, they haven't troughed yet. There isn't enough pain in the earnings. So earnings are pretty good. I mean, they're okay. So, you need earnings. I think X Energy, they're up 7% so far this year when people were calling for down 5%. So the answer is you need a lot more pain in the economy, a lot more pain in earnings. You need to dream that accommodation's 3-6 months away. Then you get in, you buy the low quality stuff that's going to survive, the small caps that then have a runway for margin expansion. But sitting here at this point in the cycle, no, and I don't think that should be surprising to people.
So simply the Fed potentially being done is not enough. And that's the central question we ask ourselves every week, because there's a new Fed speaker every week, including Mary Daly.
Okay, just shut off the video randomly. Okay, CNBC. So what's my stance on this? This gentleman clearly says, don't be buying these small caps yet. Don't come anywhere close to them yet, right? So what's my stance on that? My stance is, I think it's been a good buying opportunity. I think it continues to be a good buying opportunity. As for a long-term investor, if you're trying to time it out perfectly and hit the bottoms, maybe not, right? But I just look at it very practically. Small caps have been trading for the last year and a half or so, right? One is small caps are down. The Russell's down in the last 3 years. That's first thing. Second thing is small caps on a forward P basis are trading, have been trading about the cheapest in the past 25 years in the past year or two, right? It's not going to stay like that forever. It is like that right now, but it's not going to stay like that forever. So if you have a longer term horizon, right? Like, why would it not make sense to buy, right? And he says, well, what if things get massive deterioration? What if things improve? That's another thing you got to. This is where people are just a lot of these Wall Streeters are glued in this mentality of like, there's going to be a huge recession. It's going to be end of the world. Fed's going to have to drop rates to zero again. All these sorts of things. It's a scenario that could play out, but it might not. Has anybody played out that right now is 2002, 2003? Have they considered that? Have they considered that right now is 2002, 2003? And we are ending the tech bubble. And all the final stocks are bottoming. You had the first group of stocks bottom last year, and you got the other group bottoming this year. And then those stocks start to run, and then we have a 2004, 5, 6 time period over this next several years, right? Where all of a sudden real estate gets boosted up again because maybe interest rates drop a little bit, but then you get a massive boost up in real estate over the next several years. You get a nice move up in stock prices over the next several years, and then ultimately, 27, 28, maybe that's a 2008, 2009 time. Like that's something I don't think enough people are considering that I think they should consider is that there is a potential the next several years are actually really good. And that's something a lot of people are not ready for or not prepared for at all. And, so anyways, if we look back to 2020 and 2021, what does it most remind you of? You got to ask yourself that. It most reminds you of the tech bubble. Everybody was taking max level risk. It was the riskiest stuff everybody was buying, right? And their bubble crashed. Bitcoin fell 70-something%. We had a ton of companies go bankrupt. We had those crypto exchanges go bankrupt, like almost all of them literally went under. Coinbase stayed around, right? But almost everybody went under. You had all those big tech stocks fall 50, 60, 70% plus. You had the small caps trade the lowest valuations we've seen in decades. You had all that play out. It was very possible we just went through the tech bubble and we're troughing it now and we're about to come out the other side. And then the next few years are going to be great. There's a potential in a higher interest rate environment like we had actually in 04, 05, 06. So, I don't know, just something that should be considered out there. One of 4 scenarios that could play out over this next year. Appreciate everybody joining me as always. Thanks so much for being here, folks. Busy week ahead, obviously, in the market. And appreciate you guys. Thanks for being subscribed. New all-time high subscribers in the history of the channel. If you want access to the Black Friday deal, check out pinned comment down there, enter in your info, and we'll send that to you. That's going to be a 1-day sale on Black Friday. It's going to be absolutely massive. So access to Become Master Stock Market, what I'm up to in the market, and many other various things for $62. You can't beat it, man. Much love, and have a great day.